morning and welcome to the fourth episode in our Boardroom Forum live series where we have taken a look at topical accounting and sustainability reporting matters. My name is Taskeen Jaffer. I'm a manager in PwC's Corporate Reporting Services Division and I am very excited to be here today. Modern businesses find themselves operating in an ever-evolving landscape, facing various global shifts and challenges such as technological disruption, social inequality, and climate change. In light of this, sustainability reporting, which refers to the information that a company provides or the disclosures that it makes about how it impacts or how it is affected by various environmental, social, and governance-related matters, is becoming an increasingly important topic. Today, I am joined by Thamesha Chetty, an Associate Director in our Corporate Reporting Services Division, to help us unpack the global and local sustainability reporting landscape, the link between financial and sustainability reporting, and some practical things that companies in South Africa can consider as they navigate their sustainability reporting journey. Welcome, Thamesha.
Thanks, Taskeen. Really happy to be here today.
So, although sustainability reporting has been getting a lot more attention recently, the concept itself is actually not all that new. Could you perhaps help us understand why it has been getting greater focus in recent times?
That's a good question to start off with, Taskeen. And if we think about it, typically, what would be considered when looking at a company and whether it's considered to be successful and sustainable in future was really around its financial performance, financial position. So looking at things like, its revenues, profit measures, and other financial metrics. However, investors and other stakeholders, whether it's suppliers, consumers, employees, and so on, are now really looking at more than just financial performance in considering whether a company is considered to be viable. They really want to understand, what is the impact that companies have on the environment, on people in doing business. And they also want to understand how are companies managing sustainability-related risks and opportunities. And this was quite evident in PwC's latest Global Investor Survey, where 72% of investors, so quite a significant number of investors, said that how a company manages its sustainability-related risks and opportunities is a really key factor in their investment decision-making. And sustainability is also something that's now top of mind for business leaders. In PwC's Southern Africa CEO survey, 14% of CEOs see climate change as a key threat over the next 12 months. So you can see, Taskeen, sustainability is no longer just looking at financial performance, nor is it just a response to climate change. It's really reshaping how companies operate, report, and grow.
Okay, so it's quite clear to me from what you've said that there is both global and local interest in the sustainability of businesses and how companies report on their sustainability information. Now, what I understand is that when companies perform their sustainability reporting, they currently use a multitude of frameworks and standards, and because there's so many acronyms involved in this, it's sometimes referred to as the alphabet soup of reporting. Could you clarify for us what the current global sustainability reporting landscape actually looks like?
Sure, Taskeen, and you're quite right about the alphabet soup of reporting. And not only does this refer to, like you mentioned, the many frameworks and the acronyms used, but it also meant that companies were historically reporting on a voluntary basis, using these various different standards. However, now from a global perspective, we're moving more into a mandatory reporting sort of environment. And this brings me to two sustainability-related frameworks that I want to touch on. So the first one being the Corporate Sustainability Reporting Directive, or the CSRD. And this is a directive that stems from EU regulation. And what needs to happen is that this directive needs to be transposed into national law of EU member states. Now, if entities are within the scope of the CSRD, they will need to report in accordance with the European Sustainability Reporting Standards, or the ESRS as it's commonly referred to. Now, you might be thinking, why are we talking about EU regulation in the context of South Africa? And it's quite important to take note of this because this regulation does not only impact EU entities, but it could also impact non-EU entities. So, for example, South African companies, if they have significant operations within Europe. Now, there are quite extensive disclosure requirements resulting from these regulations, and to ease the reporting burden for preparers, there are currently a set of proposals under the omnibus package that is currently being discussed and in deliberations to be approved, which could impact the scoping and certain other requirements. So just something to take note of for companies that could be impacted by the CSRD. If we move on more broader globally, we also have the ISSB, which is the International Sustainability Standards Board, and they're really intended to be the global baseline for sustainability reporting. So to address this need from investors to have globally consistent and comparable sustainability-related standards. And they've currently issued IFRS S1, which is an overarching standard. It covers the general requirements for sustainability-related financial disclosures. And they've also issued IFRS S2, which is the first thematic standard covering climate-related disclosures. Now, unlike the EU regulations, the standards don't mandate how the standards need to be adopted, and it is up to individual territories to make that decision. And, Taskeen, looking at these two standards, it can be quite complex to understand the requirements, whether it's from a scoping perspective or the disclosure requirements themselves. And PwC has issued a sustainability reporting guide, which really contains useful guidance, insights, and examples to help preparers as they embark on their sustainability reporting journey.
So it's clear to me from what you've said that the sustainability reporting regulations could have quite a wide impact. What I am curious about, though, is you've mentioned the ISSB standards. Has South Africa adopted these standards, or how are South African companies otherwise affected by its reporting requirements?
That's another great question, Taskeen. So the ISSB standards are effective 1 January 2024, but as I mentioned a moment ago, it is subject to adoption by local territories. So from a South African perspective, it's currently not adopted, so there is no law or regulation mandating reporting in accordance with them. However, in the absence of regulations, entities can voluntarily apply the ISSB standards. However, there is currently outreach being done in the market in the form of surveys, as well as regulatory discussions taking place to understand whether the ISSB standards are suitable for adoption in South Africa, but also understanding perhaps if there's requirements that need to be tailored to take into account our South African context, what those might be. I think what's going to be quite interesting for us to understand as these developments unfold is how existing reporting practices in the market, such as reporting in accordance with the King Code, as well as the integrated reporting framework, is retained. Given the ISSB standards, focus on financial materiality or disclosing information through an investor lens, whereas current reporting practices in South Africa, also include impact reporting. So also looking at what is the impact on the environment, on people, on society, and so on. And another point I just want to highlight, Taskeen, is that, even if companies locally may not be directly within the scope of whether it's the ISSB standards or even the CSRD, they could still be called upon by reporting entities that actually do have the reporting obligation to supply them with the information they need in order to meet those requirements. And this can happen if entities locally fall within the value chain of those reporting entities. So for example, if they're a supplier, if they're a consumer. So it's quite important to take note of that as well, that even in the absence of them being directly impacted, they could still be asked to supply these entities with information that they need.
Okay, so it sounds like a company could be impacted by a sustainability reporting regulation in a country, even if they don't have operations in that country. Now, we've spoken a lot about sustainability reporting up until this point, and what I'm wondering now is, how should companies view their sustainability reporting in relation to their financial reporting? Should they look at the two together or in isolation?
So the short answer to that, Taskeen, I would say is no. So sustainability reporting should not be seen or looked at in isolation to financial reporting. And both these standards that I've been talking about up until now emphasize the need for connected information. so connections between the sustainability reporting and the financial statements. And they also contain principles to say that to the extent that it's possible to actually use the same data and assumptions that's used in the financial reporting. Now, strengthening this connection between the two is also an aim of the IASB, which is the International Accounting Standards Board. And they've actually issued an exposure draft last year, which looks to set out 8 illustrative examples to help preparers understand how to use the existing IFRS accounting standards and how to use those requirements to assess the effect of climate-related matters in the financial statements. And this is really coming from, concerns from investors to say that, in the financial statements, there was either insufficient or unclear information as to how climate-related matters were being dealt with in the financial statements. And in some instances, even having inconsistent information between what is in the financial statements and what is being disclosed outside of them. So, for example, in sustainability reports. So, Taskeen, the idea really with connectivity and reporting is to provide a really comprehensive, holistic, and coherent picture of an entity's performance. So, sustainability reporting should really supplement or complement information that's in the financial statements.
Okay. So it's clearly important that there is connectivity between an entity's financial reporting and their sustainability reporting. However, what I'm wondering is beyond just ensuring that entities tell a consistent story to their users with their financial reports and their sustainability reports, what else can companies start thinking about, and what are some of the practical next steps that they can take as they navigate their sustainability reporting journey?
I think a really key first step, Taskeen, is if there isn't already a strategy, to develop a strategy around sustainability and sustainability reporting. And further to this, it's quite important then to understand how does that strategy link or align to the overall business strategy. So it's quite key for organizations to look at sustainability related goals as being part of the core business operations rather than seeing these as separate imperatives. Now, we've also been speaking a lot about what's happening globally and locally in terms of reporting regulations. So I'd also say, make sure that you understand what is the regulations, how could they impact entities locally. And it was quite interesting, actually, from a CSRD survey that PwC performed for the first 100 reporters that went out in the past year or so. And out of the 5 territories that were considered as part of that outreach, 3 countries had not yet transposed CSRD into national law. So meaning that there was actually no legal obligation for these countries to report. However, 3 of those territories, the companies within those territories still went out voluntarily reporting information. And I think there's some learnings for us there as well here locally to say that, you don't necessarily need to wait for regulation certainty to drive your sustainability reporting journey. So while compliance with regulation does remain crucial, there are benefits to sustainability reporting over and above than just looking at it as a compliance burden. Then governance and oversight over sustainability and sustainability related information is also another key aspect. So making sure there's appropriate skills, expertise, roles assigned to the oversight and monitoring of this, and ensuring that there's appropriate processes and controls in place to really ensure a robust and quality reporting process. Then assurance is also another aspect that, is important to consider, as assurance really plays a key role in building trust in the information that's reported. And lastly, Taskeen, I would say, companies should start somewhere, irrespective of where they are on their sustainability reporting journey. And don't feel like, they should go this alone. Really engage with a trusted business partner to help them walk this journey and unlock the true value for their business.
So the key message from what you've said and what I'd like to re-emphasize is that companies shouldn't wait for regulatory action before starting on their sustainability reporting journey. They just should start somewhere. Thank you, Thamesha, for the great insights this morning, and thank you to you, our listeners. We hope that you have enjoyed our conversations with subject matter experts on this accounting and sustainability reporting series, where we have discussed some year-end reminders, IFRS 18, IFRS for SMEs, and sustainability reporting. We look forward to having you again with us in the future.